Thank you for joining today, everybody. For those that I haven't had a chance to meet before, my name is Todd Jones. I'm the Chief Investment Officer for Gratus Capital. Thanks for joining us for this August edition of Market Matters. Let's get started. So here's our normal agenda. Just one, and we're going to look at some of the economic updates that have happened over the last month, the 2022 outlook and how that might be modified or adjusted over time. And the final piece I wanted to just touch on, because I know we haven't really done this before, would be looking at what really are liquid alternative strategies, because this is a part of the portfolio we've been emphasizing more recently. I know there's some questions that clients have around these, so I figured we might as well do an intro, few slides to what these actually are, and then we can expand on that as time goes on. Let's get started and turn to the economic updates. So previously, we've been showing this chart. This is a chart that shows a progression over the last 4 years of both the services sector, which is in purple, and the manufacturing sector, which is in yellow, or orange, if you will. Just for reference, any number that's above 50 means the economy of those sectors of the economy are in expansion. Any number below 50 means that the economy is in contraction. And currently, both those numbers are expanding after having drawn down pretty severely in the COVID crisis in 2020. One thing I would want to point out is, because there's been a lot of recession chatter, and now I think that the conversation is shifting to severity. One thing of note, which I think is positive, is that while the manufacturing sector does continue to decelerate, not necessarily contract yet, but decelerate, which actually is pretty typical for the manufacturing sector, as it's very economically sensitive. The services sector last month had a nice reversion higher after having some trending towards the mean, and it looks like it's back in expansionary territory. So definitely we'll be watching the manufacturing sector because that was a good tell in previous time periods as to whether or not we were going to be hitting more severe recessionary conditions. You can see that kind of indicated that latter part of 2019 as a first warning sign. So this is something we'll be keeping an eye on, but I think it's still a mixed decision because the services are expanding, manufacturing is contracting a little bit or decelerating a little bit. So we'll just have to keep an eye on how this evolves over time. For those that tune into the 2 Minutes podcast we do every Monday, I've been talking a lot about the semantics now that are in front of us with regard to what recession we're going to experience and how severe. And I think that's really pretty clearly identified here in this chart from Axios. Just shows the number of news articles that were published on any given week, showing how many of those articles had the word recession in their title line. And so I think one takeaway from this is, and by the way, this peak coincides not coincidentally with the trough in the S&P 500 in early June. So I think one of the takeaways that I have is, and really it relates to sentiment, which is if everybody's talking about a recession, then it's more likely priced in to a high degree. And in that case, it's not necessarily worth fretting over too much because the worst may be behind us from that perspective. Let's move on to the next slide here, which just continues that. And I think this is a really important slide to show because this slide definitely speaks to, I think, what's in front of us relating to commodities. Now, energy prices, I think, clearly are clearly holding very strongly in their positive momentum for the year. That's shown here in the purple line. But interestingly, as I pointed out, probably middle of April, it was that both agricultural prices, that's corn, wheat, futures, things of that nature, as well as base metals, that's copper, zinc, aluminum, have all actually trailed off in price appreciation and are actually right around break even in the case of agricultural commodities and negative in the case of base metals. So I think it just suggests that a lot of the inflation now is certainly coming from the energy sector, but if we're getting offsets from the food and base metal sector, then will go a long way over time to bring inflation down to the number that we needed to get to, which in our opinion is below 6% before markets can break out of what we think is likely a sideways trading range for the foreseeable future. And then this is that chart that I've showed previously, but I think I do want to keep showing it until we actually reach this this point. And so just for reference again, the blue line is the month-over-month change in the CPI. The orange line is the rolling 12-month average of CPI. So from point to point, it just gives you an idea of how, inflation has evolved. And so, what I wanted to just point out here was that, even with the June number of 9.1, which certainly was a high number by all, estimates, there's still a path to a 6% trending lower number by the end of Q1, maybe early part of Q2. So that's considering, everything that's going on with inflation and how in your face it is right now. That still is the base case, is that we'll get to a 6% reading by the end of Q1, maybe early Q2. And that's really important because historically 6% has been that number for one reason or another. If you're coming from a higher number down through 6, that equity markets going back 70 years have started to post positive returns. Anything higher than 6% generally has indicated a negative return in both the stock market and the bond market. And I highlighted this in June, and I think it's it was well timed. But because markets are forward-looking, it's often easy to get caught up in the day-to-day headlines, and it's often hard to think about what actually could go right versus everything that's going wrong in front of you. And we just outlined a few items that could go right, and turns out a few of those things have already come to fruition. Number one is that in early June, in July as well, investor sentiment was very negative by many measures, whether it's the AII, Individual Investor Index, or CNN Fear Greed Index, or any number of indexes. We're all registering very nasty levels of investor sentiment. And that's reverse course, which I think has played a big role in equity markets re-rating. The other piece is that we thought that there could be a compromised tax reform bill, which is sometimes better to be lucky than good, because you never know the timing on these things. But over the last couple of weeks, I'm sure, as you all are aware, Senator Manchin has pushed forward with Senator Schumer a compromise environmental inflation. I think it's the attack inflation bill or something like that. I forget what the actual name is, but it's got some tax reform in there as well that, if passed, would be pretty sweeping. So we've got something like that kind of percolating in the background at the moment. Other two items that could go right would be a faster than expected decline in inflation. That would certainly be a positive catalyst for the markets. And then finally, a cessation, which we're all hoping for, cessation of conflicts in eastern Ukraine would really, I think, send the market into a very positive feedback loop. So we'll continue to think about these things, because it is important to keep these top of mind, because markets do have a way of re-rating fast, as we'll show you here further in the slideshow. Which takes us to the investment outlook. So I guess, to summarize the first section, it's still a little bit of a mixed picture from a broader economic perspective. On the investment side, though, it's things are getting a little bit more attractive in certain areas. One of which we highlighted more recently is an upgrade to the small cap companies. The Russell 2000 is the proxy there, have really gotten beat up in price terms relative to the S&P, and that valuation difference, which we showed last month, is really becoming more noticeable. That's still an item that we have as a research agenda item within our investment team, but nonetheless, we think that's an area that we are looking pretty carefully at right now. Still have a preference, of course, for large companies that serve us, pretty well. Relating to on the value side, on the growth side, we have had some positions that have undershot a little bit our expectations, but more recent dynamics have turned positive for us on that front. So we feel pretty good about the position we have at the moment. Still have a little bit of an underweight to international markets, and of that international exposure, we have a 15% weighting in our equity sleeve to international markets as an investment committee recommendation. We currently have no exposure, direct exposure at least, to emerging markets. I do think there are a number of issues that are starting to bubble up to the surface as inflation becomes a problem in areas. I mean, first and foremost, it was Sri Lanka, I think is an area that has experienced some issues more recently. And then, we've got other areas that are on the cusp, Pakistan and a few others, where food inflation and fuel inflation are actually having a biting impact on those areas and those governments. So something that we will probably continue to have a underweight to, assuming that the US dollar continues to remain very strong, because that's really what's been a big problem right now. The US dollar is appreciated versus almost all currencies globally this year by a pretty substantial amount, and that just creates havoc in financial systems that are non-US dollar based. On the plus side, bonds have re-rated over the course of the last 7 months to levels that once were, pretty unattractive, which, we came into the year with a substantial underweight to bonds anyway, but right now with 10-year at, 2.75, but actually more importantly, the short end of the yield curve, 1-year, 2-year over 3 is presenting some really interesting opportunities for short duration bonds that we started to implement across some accounts. And then finally, alternative strategies. I think I'm going to add another category here to include digital assets at some point. But alternative strategies have been and remain very attractive relative to other asset categories, particularly bonds, just because the forward return assumption is much higher than bonds go forward. And we say that because bond forward-looking returns, we put out a capital market assumption publication every year in case anyone wanted to take a look at it. Just ask your advisor for it. But bonds are pretty easy to impute what forward returns look like, and really it's just a function of what's the starting yield and the duration of the bond gives you your return projection. Nothing more than that. And the themes remain pretty consistent from last meeting. We still have a pretty cautious outlook for where we are at the moment. I mean, we're not making any sweeping allocation adjustments. The last adjustment that I think that was pretty sizable was downgrading our international equity position to underweight, essentially, back in March or maybe it was February of this year, right as the Ukraine war kicked off. We still just would remind clients this is likely a broader bear market rally within the context of a sideways market. And our assumption, or our highest probability, is that until we get inflation under control, there will be these wide-ranging rallies that are very sharp in nature, but we're likely going to be within a bit of a channel on the upside and the downside from a return standpoint in equities for probably the next 6 months or so, 9 months. There will be better opportunities ahead, though, and that's something that I think recessionary conditions always bring to light, is have a way of reducing prices for overvalued assets. And so one of the reasons why we want to maintain a high quality bias, particularly in things like fixed income, which we still hold and recommend holding in client accounts, is that when you're holding high quality fixed income, those have a way of holding up in very nasty economic sell-offs, and then you can reposition to more riskier fixed income asset categories like high yield bonds or preferred stock when they're at substantially higher yields. And I just would point out here as well, our alternative sleeve has done more or less exactly what we had thought it would. Not a positive return for the year, unfortunately, but better than both the stock market and the bond market. And so that's, as we'll talk about more later in the presentation, what is an alternative strategy and what are some of the ways to think about the returns that we get there. We'll outline what that looks like here in just a moment. And this is the picture of equity markets through, I think it was yesterday when I just updated this to refresh this. You can see here, through year to date, S&P is now only down roughly 13%. Small cap index is down 14 or so. And then interestingly, international developed, Chinese market and emerging markets are all down roughly 17 to 18%, which is a noticeable departure because one thing we're keeping a pretty close eye on is the Chinese market, which is here in pink. One, because they are going through rolling lockdowns across various cities. So that's absolutely having an impact on economic growth potential coming out of that region. But also, as we pointed out last time, the Chinese market led U.S. markets out of very challenging market conditions, both in 2008 and in 2020. So the fact that the Chinese market actually did bottom before most all other developed markets earlier in the year, it's still holding these levels. It's something we're going to be watching pretty carefully as to whether or not we can hold these levels that were met earlier in the year. Because if it can, it just suggests that maybe the lows are likely in for the foreseeable future, barring any new exogenous event. And apologies for the fuzziness in this graphic, but I think this is, I'll just walk you through what this is here. This is Paul Volcker's infamous rate rising interest rate cycle, where he jacked the Fed funds rate up from, I think it was 10% to call it 16 or 17% over the course of the late 1970s into the early 80s. And this is just one thing that, two things we wanted to point out here. One is that as some of these footnotes are making note of, the S&P always tends to trough before the actual announcement of an event. So in this case, the S&P bottomed before Paul Volcker made the indication or inclination that a new approach would need to be taken to tame inflation. And then roughly 6 months or so, and markets tend to discount information 6 to 9 months. But also, the other point I wanted to make is, and this is one reason why we continue to suggest having a full exposure to equities, not having necessarily any part of your capital out of the market per se, unless you're dollar cost averaging. Is that the entire drawdown of the 80 to 82 period was erased in about 4 months as a new approach was decided to be taken by the Federal Reserve, which I think sets up pretty similarly to where we are right now with the Federal Reserve today, because the Fed has just recently abandoned their forward guidance program, meaning that they were going to tell the market what they were going to do well in advance of actually doing it. The fact that they have abandoned that, I think, just suggests that they want to leave flexibility for other options or to use the tool again if conditions get a lot worse. And so I think that the conditions, to me, appear very similar to where we were in this end of the hiking cycle that occurred back in the early 80s. Now on to some good news, and I think this is another reason why markets have re-rated starting in early June, which is earnings have just started to come in for Q2, and we've gotten through about 95% of all earnings reports for Q2, and I think the evidence has been pretty strong that even though these are sometimes lower comparables, if you're beating the expectation, then that's generally good enough for a forward-looking index like the S&P 500. So what you can see here, just a way to read this chart, this is Q2 earnings growth year over year. So coming into Q2, as of June 30th, the market expected earnings to grow 4%. What actually happened was earnings grew 6.7%, which doesn't sound like a lot, but in percentage terms, it's actually double the expectation. Now, we all realize it's a small number, so it's difficult to make a lot out of small numbers sometimes. But I think where there's been some substantial outperformance, or areas that we currently like, particularly in our single stock strategy, and I'll touch on why that is in just a moment. But the two areas I highlighted here are energy, which you can see pretty monstrous earnings growth exceeding the expectation, 220% year over year. What actually happened was about 300% earnings growth, which sounds like a lot, but in the context of the energy sector only being about 4% of the S&P, it's not that contributory to S&P earnings. But I think what's more important, or maybe more meaningful, is that the healthcare sector came into Q2 with the expectation of just flat earnings, 0.6% growth. And what actually happened was the healthcare sector grew earnings by roughly 7%. And I think this attractiveness of the healthcare sector in particular is now starting to manifest itself in a lot of the M&A activity that's starting to occur. So, we talked about this as an investment team more recently, but there's been a noticeable uptick in merger and acquisition activity in the healthcare sector in particular. And so that, I think, just suggests that strategic buyers now see pretty discernible value in certain parts of the healthcare sector that they were waiting and being cautious with their capital, but now it's the appropriate valuation and time to step in because these opportunities might be fleeting. And we've been adding to both of these areas in our portfolio over the last 4 to 6 months, if you will. And similar setups, but something I would just point out as well is, this is the forward PE ratio, what you're seeing on the by sector. And what this is measuring is, how over the average or how under average are each of these sectors. So just the way to read this is, in red here, the consumer staples, consumer discretionary utilities are overvalued relative to their long-term averages as far as PE ratio is concerned. These are not areas that we've been adding to for anyone that's been watching what we're doing in the individual stock portfolios, because it just sets up poorly if you're adding to a position that from a sector standpoint already is overvalued. And areas that we are adding to, like healthcare and energy, remain pretty undervalued relative to their long-term forward PE ratio. And you can see real estate now is trading at a discount, although real estate is a little bit different or a little bit misleading because a lot of this derating has occurred in the office sector. So I wouldn't necessarily call real estate a screaming buy right now, but just sectors that we understand pretty well. Healthcare and energy continue to be very attractive, and we have added this not only in our core model accounts, but also in the single stock strategies. So I guess maybe to net out the equity section, we still think there's a lot to do on the equity side, and there are opportunities. We just have to be patient for them to manifest themselves. A picture of fixed income, and this is obviously not a very pretty picture across the board, particularly if you owned, longer term treasury positions that were, 20 plus years or greater, or emerging market debt and most clients know that we've been very vocal about not owning these sectors. We see really no utility in owning a 30-year bond right now because the yield is just very unattractive relative to inflation, but also long-term opportunity set. And emerging market debt is always that segment of the portfolio that always holds lots of promise until an emerging market blows up. And having lived in emerging markets in my prior life, I can tell you that these are areas that will continue to have issues barring any substantial reforms across some of those regions. So we've continued to maintain our exposure to, in relative terms, the two areas that have done the best this year, which would be municipal bonds, which are performing a little bit better than the aggregate bond investment grade index, and then the investment grade bond or aggregate bond index, which is a combination of corporates and investment grade corporate and treasury positions. But again, the benefit, or I think one of the other ways to think about fixed income for this year is in advance of these drawdowns. For those clients who've been with us for a while, you may recall we've been downgrading our fixed income position at the expense of adding to liquid alternative positions or private market positions for quite some time. Actually, starting in 2016 is when we started adding liquid alternative positions because, frankly, if we couldn't earn a yield that was higher than inflation in the fixed income, then by extension, we should start to minimize that allocation. But with yields having risen, that's an opportunity potentially to add more to those areas. I did want to touch a little bit on the yield curve because I know there's a lot of press being written about an inverted yield curve, and certainly if you look at, well, let me just orient you to the chart here real quick. So a yield curve just basically shows what yields are across various points of the maturity spectrum. So a 1-month bond yielded on January 2nd, January 1st, 5 basis points or something. On January 1st, a 30-year bond yielded 2%. So this is kind of just the way to orient this. This is the January yield curve. This is the August yield curve as of today. And I wanted to make sure I added this because it's really important to understand what's going on here. So what you'll notice here, it's, well, I guess just for general information, a yield curve that looks like this, they call this a steep yield curve, which means that the longer end of the bond market is yielding higher than the shorter end. That just indicates general economic health because longer term investments should be yielding more than short-term investments generally. But when you have this situation here, when it's flattened out quite a bit, that suggests that there could be economic trouble on the horizon. And we've been talking about this for a little bit of time, but the yield curve is usually generally first to suggest that there are problems on the horizon. The 2-year yield minus the 10-year yield, that's a spread, actually went negative, which means that the 2-year bond was yielding higher than the 10-year bond many weeks ago, and kind of triggered some of this writing about recession articles. So I guess to level set, we do think that there is a recession in front of us. We did get 2 quarters of negative GDP, first quarter and second quarter, but that, again, a lot of that downside from an economic standpoint is probably already priced in because GDP is a backward-looking measure. It's not forward-looking. And so one other thing I just wanted to point out here is that we do think that now is an interesting opportunity to look at shorter duration positions, particularly risk-free treasuries. When you're getting a starting yield of over 3% on a 1-year bond, or even a 6-month bond, treasury bill, that's a pretty decent starting point relative to what you would be getting out here in the 10-year or 30-year tenors, if you will. So again, we recognize that the yield curve is inverted. That does create some anxiety with some clients or investors. But again, I think most of that issue or that risk has likely been priced in for a little bit of time. And we will certainly make adjustments if we need to based on severity. But our base case is that this is going to be a fairly mild recession that's in front of us. And then just going back to revisit, why do we even own bonds in the first place? I chose, so Vanguard does a good job sometimes putting out some really interesting content. And I thought, 2 different periods to look at how bonds performed in rising interest rate periods would be useful to take a look at. So everyone's familiar with, the idea that interest rates rose pretty meaningfully in the 1970s into the early 80s. And what this chart just shows you is that while there was some, price decline in the aggregate bond index over this time frame, a small loss over this whole time series, you actually more than made up for that capital loss in the fact that income, particularly if you're reinvesting the income, was constantly being reinvested at higher income rates. So, if your index started off with a 2% yield at the beginning of the year, which is about where we were. Now we're at about a 3% yield. That 1% difference will impact price, but over time, what's actually more important is that your income return continues to rise, and that's something that I think is really useful to have as a source of return because it's a different source of return. It's contractual, and bonds, when significant economic events happen, shock events, generally always perform in a positive way. Which is a little bit different than this year. This year was not necessarily a shock event per se. It was more of a valuation derating. But if we got some sort of very adverse event similar to COVID and what happened during COVID, bond yields went to the floor, prices went up, and bonds had a pretty good year for that year. I also wanted to show the 99 to 2022 timeframe, where again, not much was earned in price return. So this is not to be thought of as similar to a stock. You don't necessarily invest in bonds for capital appreciation. But what you do invest in bonds for is income return, which you can see is over this time frame was absolutely the main source of return over this 99 to 2022 period. So I guess the point I wanted to make here is that if you see on your statements or in the portal that you've got a capital loss in your bond position, that's actually not terribly unusual with regard to what some of the expectation is for bonds at points, because a bond really shouldn't have much price appreciation unless interest rates are going down overall, and that's not the case right now. So just some takeaways before we get to the special topic, which is similar and to prior periods, but just bears worth mentioning. Still have a preference for equities over bonds in particular. I think Q1 performance, this is of course despite Q1 performance where stocks were down through June 30th, about 20% or so. We still think that there is a risk to the upside for yields, which could impact bond prices, and therefore we need to just continue to manage that exposure. And generally, equities over long periods of time are able to handle inflation much better than bonds. Alternative strategies over bonds. So we have made many adjustments, and more recently, I think we're at the lowest weighting to bonds we've ever had in our portfolios coming into 2022. That continues to be the case, but it's important to remember, when bond yields finally get back to a level that's meeting inflation, then we will absolutely look to right-size our bond allocation relative to alternative strategies. We definitely expect more volatility within markets in 22 through the end of the year. I think what's generating most of this volatility you're seeing in the stock market actually is the bond market itself. I mean, if there's, I think, a slide I'm going to put together for the next Market Matters that just shows that daily moves on the 10-year bond yield are some of the highest we've seen in 20 years. So there's actually an index that measures this called the MOVE Index, if anyone's interested to take a look at it, which shows a rough proxy for bond volatility, and go figure it's rising. So until bond volatility starts to tamp down, it's probably going to be choppy waters for the foreseeable future. And then just one update here we've made since last month is that, for ultra shorts, bond positions versus money markets or cash, custodians or banks are usually very slow to start raising money market rates or savings rates. But if you're willing to go through the complication, if you will, of buying an ultra short-term bond ETF at these levels, or just a short 6 or 9 month treasury, your yield can be substantially higher than what you would get at the bank or money market position currently. So with that, let's just take a view here and a look at this new topic or new section that we've had some feedback from clients. They just wanted to understand more about what are alternative strategies, what are the key criteria to qualify as such. So let's just go through a couple, and we'll be likely adding to this presentation over time that I'll share with the advisors that they can share with you, and then maybe we'll do another update to this at some point later, either this year or next year. So what are alternatives is the existential question maybe in front of us. And our definition is an alternative strategy is something that generates a return with a low correlation to both the stock market and the bond market. So, really, this is hammering home the concept of diversification. Our level, if you look at statistically, a 0.7 correlation is generally considered to be relatively uncorrelated. And just for reference, a correlation of 1 means that every move is of a reference index is entirely explained by the movement of the asset you're measuring it against, right? So if the stock market went up 5 days in a row and your REIT position went up 5 days in a row, that would be a correlation of 1, meaning every movement up was matched by an equal movement up of the asset. But it's important, I think, as what's the bond market is showing us, is that there are strategies that are bond centric, but we don't necessarily want bond or interest rate or duration exposure. So these are just some examples, historical examples, but also more recent ones of what would be considered liquid alternative strategies. So things like real estate investment trusts. Unfortunately, REITs have been increasingly correlated with public markets, equity markets. So in our opinion, they become less of a alternative asset and more just a correlated asset, but nonetheless, they do and can play a role in a diversified portfolio. Digital assets, this is certainly an area of interest of ours. And historically, I think what you would find if you were to correlate the return of things like Bitcoin versus the S&P, that you would find it's not very correlated at all. Commodities generally have a very low correlation to stocks or bonds, so they are generally not influenced by what's going on in either of those markets, or things like listed infrastructure. There's toll road companies, pipeline companies, which do have some correlations to equity markets, but it's low enough to meet our threshold and our criteria. And we do try to incorporate these whenever possible, based on market dynamics. On the non-liquid side, this is an area we spend a lot of focus on our private funds, but increasingly available in things like interval fund strategies. And those would be things like private real estate, private infrastructure, private equity, venture capital, so on and so forth. And then these are crossover strategies that could be liquid or could be non-liquid, if you will, but things like long short equity or debt, market neutral, trend following, strategic income, and arbitrage strategies. And for today's discussion, I don't want to go through all of these because that would take quite a bit of time. But I think just introducing you to a couple might be useful in helping you think about what is an alternative strategy and what the return profile might look like. So going back to, again, this kind of builds the case for, or I think tries to provide some data that would show that, all of these types of assets don't necessarily correlate to public stock markets or public bond markets. So things in green have a low correlation, things in red have a high correlation. So for example, if you look at things like timber, if you can get exposure to it, timber investing has actually a negative correlation, a very slightly negative correlation to both global bond markets returns and global stock returns. Things like core infrastructure, again, we mentioned that earlier, have a slightly negative return to both bonds and stocks. And so again, the expectation would be if either of both of those markets are down, then these assets actually might be generating a positive return during those time frames. And then you get into some of these strategies we'll cover today, which is macro strategies or trend following. Those typically have a very low correlation to both the stock market and the bond market. And then I mentioned Bitcoin. This is the evidence, if you will, to suggest that this is a low correlated asset. Not to say that we're going to drop it into clients' managed accounts. So don't, fear that that's happening, anytime in the near future. But it's just, I think the evidence would suggest that these are all would qualify as non-correlated strategies and thus alternative. And the idea is it's not that we want to make portfolio management or our lives, anyone's lives, more complicated. The idea with adding alternatives to a portfolio is actually to smooth the ride a little bit, because if you have a non-correlated asset that's positive when everything else is negative, or at least not falling in value, then that has a way of lowering the hurdle that the portfolio has to jump over when the recovery phase comes. So you can see a few examples here, like the 60-40. This is traditional 60-40, and these are returns, risk and returns. On the bottom axis, it's volatility of that portfolio. And then on this axis right here, we've got the returns annualized from 1989 to 2021. So 60-40, just a way to read this, traditional stock and bond portfolio generated about 9.1% over that time frame with a 9.3% volatility. And what this chart right here suggests is that if you add alternatives, and there's a definition of what that actually is down below, but if you were to add generally at the expense of bonds, but some at the expense of some equity, that your return profile would improve pretty meaningfully. So you're looking at a 30% weighting, looking at 30% bond weighting, and then 40% equity. So the volatility would go from 9.3 down to 7.7, but the return would also increase because it's a bit of a smoother ride from 9.1 to 9.58. So it doesn't sound like it's a lot, 40 basis points or so, but you annualize that over time, that can have a way of adding up to some meaningful value increase. This is kind of the why. This is why we even want to consider doing this. And then just one example that I would point to here, there's another one that you can certainly look at if you want to after this call today. But one thing that's we've owned on and off over the years would be trend following. So trend following is our quantitative strategies that take their trading strategies and they go They take long and short positions in a variety of all types of financial indexes. So that would be stock indexes, bond indexes, currency indexes, and commodity indexes. And the determining, whether to go long or short is really based on a number of different things, but typically it's a trend in one direction or the other. So for example, maybe one strategy would be if the S&P has shown a positive performance over the last 1 week, 1 month, and 3 month time period, then the strategy would go long, meaning they would buy the S&P index under the idea that there's a persistence to the return that generally follows those periods lining up in a positive way. And conversely, if oil prices were negative over the last 1 week, 1 month, and 3 months, then the strategy might go short oil contracts under the idea that there is a trend developing that was short to intermediate term in nature that could continue on in that direction. So what are the pros and cons of a trend following strategy? Well, I would say we haven't owned them, over long time frames. I think there are, as this chart up here in the upper right would suggest, there are periods of time where trend following strategies can work really well. So when I was first coming to Gratus in 2008, we owned a trend following strategy that performed remarkably well during that time frame, because what happened was the trend following strategy took short positions in equities, currencies, and commodities, just as markets, Lehman went bankrupt and markets sold off dramatically. But I would say there are times to own trend following and times not to. We ended up selling that position in 2009, middle of 2009, because trends were getting a little bit more difficult to attach to, given the significant involvement of the Federal Reserve and such. And that's kind of what I'm trying to highlight here in the green areas, is that during substantial risk off periods, if you will, is really when these trend following strategies have a way of working, which also coincides with a pretty substantial uptick in market volatility. And so the time, in our opinion, to look at or add trend following strategies to a portfolio is when volatility has been on the upswing, has been on the rise overall over a longer time frame. And so I would say, just dovetailing into what are the cons of the strategy? Well, they do have a higher cost to manage or run internally than index ETFs or stock strategies. But that higher cost does come with typically some very substantial returns in challenging periods. So anyway, I thought it was important. This is probably one of the more complicated strategies to review or take a look at, but definitely one that we think has some legs to it, particularly if we're going to be seeing significant amounts of equity or bond volatility in front of us. This is one of those areas that has a high likelihood of working in this environment. I wanted to point out a few things. One is that so just for reference, this is the S&P index right here. This is the volatility index down below, and then this is the index of trend following strategies over time. So clearly you can see here, and I think our sale was well timed, because trend following strategies did not have a good run during a very low volatility environment when the market was recovering off of the financial crisis, because I think central bank involvement did a big influence the markets in a way that didn't allow some of these trend following strategies to work as designed. Okay, well, I know that's been a lot. Thanks for sticking with it. We certainly look forward to bringing you more updates in the future on alternative strategies or educational opportunities. We will be doing another Market Matters next month. And then, of course, feel free to tune in to the 2 Minutes with Todd we do every Monday. And I just wanted to say have a great rest of the week and look forward to talking to you soon.